On Friday, we got non-farm payrolls, and it pretty much came in line with expectations. We did, however, see some downward revisions from the previous 2 months. Revisions are pretty much par for the course, and if you actually looked at the data, the information that we get says preliminary. So these downgrades are pretty consistent throughout time with the data points we've been getting. All right, so what does the non-farm payrolls numbers mean? Basically, the way I'm looking at this and how this plays out for the stock market, QQQ, SPX, the Federal Reserve doesn't really have necessarily information to be in a rush to lower interest rates. And that's something I'm really kind of keying in on, is the fact that the unemployment rate is slowly inching higher, which means that the Federal Reserve doesn't have anything to really be in a rush to move. While they may do a decrease in interest rates, I think in November, December, they may do one this year, but don't expect, and this is really where I'm kind of keying in on, is don't expect that there's just going to be this continuation of interest rates dropping every single meeting after meeting after meeting. I'm looking at this saying this is going to be a begrudgingly slow process. And during that time, the stock market might get a little hissy fit, if you will. When you look at the stock market itself, and I have some charts I want to show you on DIA, SPY, and QQQ. Those three, the ETFs for the majors indices, you can see that on a breadth perspective, there isn't a whole lot with the broader market. That QQQ itself is taking off, and it's just a few stocks within there. The rest of the market is kind of flatline, and that might actually be a problem going forward, that we might see some of the major indices moving lower, where at the same time we're seeing a few stocks pull NASDAQ up higher. So I wanted to break down the non-farm payrolls numbers so you can see what I'm looking at, and they largely came in with expectations, but also look at the stock market so you can see the breadth or the lack thereof with what's going on and how this might affect the stock market moving forward with employment and lowering interest rates by the Federal Reserve. Let's jump in. Here's a look at the actual non-farm payrolls monthly change. The previous month, we had a pretty decent number. That dropped about 60,000 from where it was. Again, these numbers are preliminary. If you actually look at the data, it always has a P in parentheses right next to the data points for the last 2 to 3 data points. So nothing new there that we see revisions downward. And this kind of goes in line with what I've been looking at, that the employment numbers are not really going to be gaining too much too fast, because there's really no catalyst events that are going to drive employment higher. The big moves that we did see upward in non-farm payrolls, healthcare and government. The rest, flatline, maybe moving downward with manufacturing losing jobs and services and financial losing jobs as well. So the breadth there isn't exactly moving forward. We saw a bunch of teachers getting hired. Great. Healthcare really kind of drove everything, though. Here is a look at the civilian labor force and employed civilian labor force. So these are the total number of individuals in the labor force and those that are employed. You take the blue, subtract the green, you get the unemployed numbers, and I have that in a second. But you can see that we're pretty much, the civilian labor force hasn't really kind of moved higher. The population gain isn't moving. And the thing that really you need to understand with the civilian labor force is simply this. The BLS goes around, Bureau of Labor Statistics goes around, and they make about 60,000 phone calls every month to come up with these data points. And they ask the question, are you employed? Do you want a job? How long has it been since you've been looking for a job? At a certain point, if you've not gotten a job, they think you don't want a job. And so you get some specialized individuals who are can only be employed by like one company in the entire country. They drop off. But then you get the individuals on the lower ends who could go work for McDonald's or DoorDash, and they probably would end up doing something like that. So that's how that breaks down. Here is the unemployed civilian labor force starting to move higher, and you can kind of see the two charts there and how they compare. This is giving us the unemployment rate. We've not seen 4%. We got 4.053 unemployed. This is the first time we've seen 4% since, I think, January 2022. Very slow, gradual pace. 4% is a decent number. To be honest with you, 3.4%, where I think was the all-time low, a 60-year low that we'd seen a few months ago or about a year ago, that's too much. It's one of the reasons why we have inflation problems. So what is normal? We used to think 5% was a normalized unemployment rate. Sub 4%, probably a bit too much. If we camp out right around 4.25 to 4.75, that's probably a healthy number for the economy, and we wouldn't see too much in the way of price pressures. So we're going to be getting closer to that number of what would be considered rational full employment. Here is a look at the U.S. 10-year Treasury. I always choose the 10-year because it's a good midway point between the short-term overnight rate or the 2-year and the 30. And over the weekend, the holiday weekend, and I didn't really do a whole lot over the weekend, stock market actually rallied on Friday, which I thought was kind of surprising. I thought everybody would be on vacation because it was an easy 4-day weekend. They did have a half day on Wednesday. The 10-year did fall in yield, as you can see in this chart. It's kind of maintaining a flat line level. I don't expect that the 10-year is going to necessarily drop too much too fast. And this is really kind of the thesis that I'm sort of operating on. The Federal Reserve will lower interest rates, just not at a really fast pace. Now, there's another issue that's on the horizon, sort of an asterisk, that always gets talked about but never seems to really be that big of a problem or issue. Debt to GDP. I don't have a chart on that right now, but it is something. I'll probably do a video on TLT stock here in the next couple of days, specifically looking at interest rates. And I want to point out debt to GDP. It's starting to move higher, which is kind of surprising because we're at full employment. So this debt level on a percentage basis versus GDP might not necessarily be sustainable in the sense that there's going to be a lot of supply. And because there's going to be a lot of supply, price has to go down to entice buyers, which means yield goes up. So it should be an interesting interplay. The actual debt itself, people keep buying it. It's not a problem until it becomes a problem. And right now it's not a problem. But it's a matter of supply and demand, price, discovery. In the meantime, I'm looking at a flat line, U.S. 10-year Treasury, and I don't expect it to move that much higher. Here's a good look at this is the SPY. This is DIA. All right. And as you can see, we did shoot up a little bit this morning, and it's kind of moving sideways to downward. Don't expect a whole lot of movement. But this particular chart, you can see DIA stock did not clear its previous highs from all the way back in May. Then we moved to SPY stock. This one, of course, has hit new all-time highs, but this is a much more broad 500 stocks hitting the entire economy. This is the one I usually defer to because it is 500 different stocks, and it really, all 11 sectors kind of looks at everything. We have seen big moves higher since the CPI data point we got about 2 weeks ago. And you can see in the last few couple of weeks, the big moves higher. Then we got, this is QQQ, Invesco's QQQ. This one just seems to be on a tear, but it's the breadth that you really kind of look at that sits there and says, you know, this isn't really necessarily a broad-based economic move with these stocks higher. When you look at all three, here's a look at QQQ versus SPY stock and DIA stock. You can see that the clear winners, since all three of them converged right around the end of May on a percentage basis. Since then, you can see some pretty decent sized moves upward in all of these, but NASDAQ is really pushing it more so. And the reason is, of course, a few stocks within the entire economy. Specifically, I'm calling out on NVDA. NVDA stock is a symbol. This one been on a tear, more so than the rest of the economy. And when you look at all these stocks combined, the three majors, DIA, SPY, QQQ, when you combine all three and you look at them and the breadth, you see that NASDAQ's really taking off. But then you take a look at NASDAQ versus QQQ and you see that, QQQ versus NVIDIA, and you can see sort of the genesis of what's really driving this. Broad-based across the economy, not really moving higher, but it's those select stocks that are really tearing things up. And should they see any kind of hiccup in growth, should NVIDIA stock, and I think they report in August, when we get that report, if they don't hit some spectacular number, that could get ugly for the broader stock market itself. So much is resting on that one particular stock. Apple stock, of course, has moved some things. Your major, the 5 or 7, however many you want to count, those major stocks have really driven a portion of the stock market more so than the broader stock market itself. So if the Federal Reserve does take their time to lower interest rates, the broader economy, the Dow 30, the S&P 500 is really going to start to be weighed upon by interest rates not moving lower at a pace that the stock market is hoping. And this is what I'm really focusing on. The unemployment rate doesn't give the Federal Reserve any reason to sit there and say, wow, okay, we need to start moving. In fact, the unemployment rate is just a very gradual move, and it is a lagging indicator, but so is inflation price pressures. With those inflation price pressures slowly, gradually getting there, and unemployment slowly, gradually moving a bit higher, still below median numbers for full employment, the Federal Reserve will lower interest rates, but at a pace that will be very slow and frustrating. And it will affect the broader stock market more so than a select few stocks. But if those select few stocks start taking a hit because they start missing numbers, could get ugly. Make sure to hit that like and follow button. We got a few more data points, economic data points I want to cover coming in over the next 2 weeks. We'll see you in the next video.